It's a real pleasure to be here today, and thank you for the opportunity of walking you through Boss Energy and the Honeymoon Uranium Mine. We find ourselves in a fascinating time of the market. The macro is tightening, and currently investor sentiment is front-running an expected increase in the commodity price. But it's important to bear in mind that the fundamentals giving rise to this market existed long before the COVID pandemic. For many years now, we've seen an increase in demand, we've seen cutbacks in supply and a drawdown on inventory. Geopolitical risk is prevalent, and Boss Energy is in a really good position, being based in Australia, to capitalise upon this. The strong market fundamentals on the slide before you shows the opportunity, shows that the market is tightening and the macro picture gets more and more optimistic. There's rising demand. In fact, there's been the highest growth in nuclear power plants since the 1990s over the past 30 years. Demand has been deferred. New entrants are yet to enter the market, and it's shaping up to be another new cycle. In terms of reduced production, we've seen more recently from COVID-19, you've seen cutbacks in supply, you've seen operations going offline, such as ERA's Ranger project in the Northern Territory and Nigeria. You've also seen cutback in supply due to those mine closures, and COVID-19 has effectively, such as Cigar Lake, with Cameco's operations in Canada, all of which is causing this tightening of demand. But the falling prices over the last decade has really brought that to a head as well, such that existing producers have found it difficult to stay operating when those legacy contracts that supported them off the last bull run have now come to the end of its useful life. As they're going into care and maintenance, there's just no new mines being built and no new mines being developed. So those barriers to entry still remain very true as well. This geopolitically sensitive product is heavily dependent on being fully permitted, and those permits are an onerous task to achieve. Pleased to say that Boss Energy and Honeymoon can meet all of these criteria and is a fully permitted mining operation. The slide in front of you is probably the best independent slide I can find, produced by TradeTech, which is a leading analyst within uranium. There you can see the orange bars on the screen are when new supply is needed or re-emerging projects need to come back on, which starts in 2022-23. Now this graph was produced in the middle of last year on the basis that all those producers that said they could come into production would come into production, most of which needing a higher incentive price than what's currently in the market. That hasn't happened. So if anything, this recovery curve is being brought forward. What's also important to bear in mind here is that from the date of signing a contract to first delivery is typically 18 to 24 months, such that we would ordinarily be signing contracts now to deliver into 2023-24. And that's what gives us the confidence that the market's beginning to change, and by that volume and interaction with utilities worldwide. This graph shows you, it's a standard one shown in the industry. It's really to highlight a number of factors. Firstly, that term contract prices are what we really focus on. They currently run at about a premium of 20 to 25% higher than the spot price. Currently, term contracts are being entered with a spot price of around 30. Term contracts are being entered into in the high 30s. Our all-in cost is $32 US per pound, and that's pre the enhanced feasibility study due out in the next quarter. So arguably, we're cash flow positive at the moment. But what I wanted to draw your attention to on this slide is the bit that I've circled there, which shows the sharp increase in the market in the last bull run from the years 2006 to 2012. At that time, I was the CFO of Kalahari Minerals, with its 43% holding in Extract Resources, which many of you may remember from the last bull run, and its great returns on the ASX. We are now finding ourselves what we believe to be in the start of the next cycle. And the benefit of Boss Energy is that it's got the ability to have that first mover advantage. It's a restart project. And the wonderful thing about restart projects is that you've got the ability to look back and capitalise on prior operations with a quick restart of 12 months. Our plan is to then layer into contracts as we go into the rising market, such that we protect the downside, but with enough flexibility to take advantage of the upside. It was in 2016 that I was the finance director of the Husab mine in Namibia when I was offered the role to take on the Honeymoon project. And I didn't hesitate. For the reasons that I'll show you now, Boss Energy ticks all the boxes that one should consider when making an investment into a uranium project. Its stage of project development, it is a pure brownfield uranium restart project that's previously produced and exported uranium around the world. It's been in care and maintenance, really good condition over the last 5 years. It is fully permitted with a large JORC resource of 72 million pounds. The capex required is one of the lowest capital intensities in the global industry of just 63 million US. The jurisdiction, this is so important. It's a first world jurisdiction. It's a tier 1 mining jurisdiction. It's a sought after destination from utilities wishing to decrease their supply risk. South Australia is the premier uranium state in Australia for producing uranium. It's currently got, as Paul mentioned, the only 2 uranium mines operating in Australia, being Olympic Dam, where uranium's a byproduct, and General Atomics project called Heathgate. We are the 3rd fully permitted operation. We have full state and federal government support and are destined to be Australia's next uranium producer. From a permitting perspective, we are 100% permitted, i.e. we can get into production without any more red tape as soon as we sign an offtake. And we have full native title agreements in place. We also have an export permit for the next 5 years at £3.3 million. Our time to production, as mentioned, is 12 months, which is one of the quickest, in fact, one of the quickest out of 1 or 2 to be back in production in the next cycle. We also have an extremely low operating cost, putting us in the lowest cost quartiles globally. As mentioned, our all-in cost is currently 32 US per pound, but we believe with the enhanced feasibility study that we will lower that, and cash cost 20 US per pound or lower. And from a management team, which is so critically important, when that bull run starts again, we're already seeing it in the market, it's really difficult to retain skilled labour and find that talent. But we have a strong board and management team with significant experience within the global industry in uranium mine construction and uranium mine operation. Where we are located, as mentioned, South Australia, we're about 80 kilometres northwest of Broken Hill, situated there close to the border. You can see Port Adelaide, it's the main shipping destination of uranium within Australia. It's shipped uranium for 30 years, incident-free. There are established shipping routes around the world to global utilities. As mentioned, we have full government support. And being the tier 1 jurisdiction, the other benefit of that, of course, is that the main sort of talent pool of labour and experience resides in South Australia that we can look to draw upon. In terms of the resource, large JORC resource, 71.6 million pounds, half of which actually resides on the fully permitted mine licence. That part of the resource is what I've included in the feasibility study. We released the feasibility study on the 20th of January last year. We're about to release the enhanced feasibility study. The benefit of that is that while we are only talking about that resource, we can then capitalise on the remaining JORC resource. And in addition, we have up to £190 million of exploration upside on which we wish to capitalise. So on the screen there, you can see the dark yellow sort of on the right, this leafy sort of sea dragon type shape. They're actually the uranium paleo channels. And if you can look closely, there on the bottom right of the corner is the Honeymoon Mine in red. And the asterisks represent some drill-ready targets. So last year we were sort of limited in what we could do on field work activities in South Australia. So we conducted a very extensive geological review of all drill results, over 5,000 drill results of the past year, to sort of further define our geological knowledge. And what we've achieved is we've culminated concentrated 22 different geological databases of 2-dimensional modelling into one geological database of 3-dimensional modelling. We have a very good grasp of our resource. The mineralisation sits at an average of 100 metres in depth, which is perfect for in situ recovery, which is our method of mining, which is low cost. It accounts for about 50% of the world's supply of production. The grade of 620 ppm is very respectable, and our cut-off grade is 250 ppm, i.e. we don't look at material that's lower in grade than that. Taking a bird's eye view of the Honeymoon Mine, over $170 million was spent on the site infrastructure back in 2012, 2013. We have access to road, to rail, We draw our power off the grid from Broken Hill. To the right of the picture there, you can see the production well fields. That's the highest grade of the mining licence, up on average around 1,000, 1,100 ppm. There are 4 existing well fields there. 1 has been depleted by the previous owners, Uranium 1. The other 3 are ready to go, and that's what will account for the first 3 to 4 years of production. The camp can house up to 200 people. We have access to water from the underground aquifer, and it really is a Rolls Royce of a plant. If anything, Uranium 1 probably overcapitalised on this plant, but that's to our advantage. It operated for 18 months before going into care and maintenance. We are now looking to replace the existing solvent extraction columns, which you can see just above the production facility button there, with NIM6 ion exchange columns. Similar to in situ recovery, ion exchange accounts for half the world's production. It's what's used throughout Kazakhstan and Wyoming. It's a very well-known use of production. We're adopting a stage approach. Within the first 12 months, we can be producing just shy of £1 million per annum and then ramping that up to £2 million as announced in our feasibility study. But our goal in the enhanced feasibility study is to actually lift that further up to nameplate capacity of up to £2.45 million. The third stage is the £3.3 million, which as mentioned is our export permit. And to meet that gap, we'll be looking to exploit that additional JORC resource that sits outside the mining licence and exploit our additional exploration target. It's ready to go. 12 months is a very, very quick startup, ready to take advantage of that first mover aspect that we can capitalise upon. In the feasibility study that I released last year, we used a base case price of 50 US per pound. It's low. We expect prices to go significantly higher. But I did that for the main reason that at that level, we can see that our NPV is at least 2.5 times our CapEx and IRR above 30%. And to my mind, that's a good sort of thesis for any investment decision. Of course, the upside is as we gain traction with the uranium price that we'll be layering in our contracts. When I look at the strategy, as announced to the market, we're trying to align all these various factors in the in parallel, such that within 3 or 4 months we will be fully positioned, ready to go. Our enhanced feasibility study, as mentioned, will come out in the second quarter of this year, possibly the end of April, early May. I announced to the market last Tuesday that we've initiated our project funding debt financing discussions, and by that, with experience, rather than wait till we land the first offtake, what we're looking to do is try and identify those financiers around the world, whether it be traditional banks or shadow banks that are willing to finance uranium and the project being Honeymoon, such that when we do land an offtake that we've been through that first initiation stage. Our strategy, our timetable is looking to have all these aspects in parallel such that when we make the offtake agreement, we can move very quickly. Strong progress is being made on the enhanced feasibility study. As mentioned, it's looking to increase the nameplate capacity up to 2.45 million pounds per annum, but also reduce our capex and operating costs significantly. And that's going to provide that base case start for that initial first mover advantage. And again, no permitting is required on the mining licence. This means there's substantial scope in the mine life and to increase the production profile. As mentioned, ion exchange is our preference going forward in terms of production. It accounts for 50% of the world's supply of uranium. Just a quick bubble graph to put us in comparison to other projects around the world. The colour of the bubbles represent the stage of development. The darker the colour represents the definitive feasibility study. And there you can see the Honeymoon Uranium project in the lower left of the quadrant with its lower cost and lower capital outlay. It really does have that first mover advantage. What this slide doesn't show is actually the qualitative aspects that we have in terms of the board, in terms of the experienced personnel and being fully permitted. But when we look at the corporate overview, we really do have executives that are very experienced with the market that have built, produced and exported uranium. In terms of Peter O'Connor, he's senior non-executive of Northern Star. He joined the company when it was around a 300 million market cap to where it is today at 10 billion. Very experienced, particularly with the global markets. Bryn Jones, Executive Director, Technical Director, had a career in the industry, started off with General Atomics Heathgate Mine, which is our nearest mine, some 300 kilometres north to our west. He had 10 years there, and more recently he's been the COO of the Laramide Uranium Project. Wyatt Buck, one of the most experienced operators and project execution chaps within Australia. He had his foundation 15 years with Cameco. He ended up running the world's largest uranium mine, being McArthur River. He was then headhunted to join Paladin, and he saw the Langer Heinrich mine in Namibia from its commissioning to its nameplate production. And more recently, in the last decade, he's been the Director of Operations for First Quantum. And Dudley Kingsnorth, very experienced internationally, metallurgist and experienced at bringing projects from its feasibility study into construction. Strategic and marketing advisor Sashi Davies is one of the world's top uranium traders. She's currently part-time with us. Her other time is actually trading physically uranium. She sits on the board of governors for the World Nuclear Fuel Markets, probably the most preeminent uranium nuclear fuel bodies there are in the world. Very, very experienced, and I've had the pleasure of working with Sashi for the past decade. In addition, we've recently recruited an owners team comprising of Merrill Lynch, Trevor Robinson and Jeremy Green, some of the most experienced available ion exchange personnel within Australia. We've got great coverage from a number of analysts, including Canaccord, Euros Hartley, Shaw and Partners. Sprott are about to initiate on us as well, which will be the first time Sprott's taken on an ASX company in the last few years, which is a terrific indication and shows that they're about to take a plunge into the uranium market. We currently have a share price around 12 cents. We have no debt whatsoever. We only meet our current liabilities as and when they fall due. We have a cash at bank of $15.5 million. In addition, restricted cash of $8.8 million, which is 100% covering our environmental bond. While we've evolved the board over the past few years, we've also evolved the share register. We have Paradise Investment Partners holding 10%, Tribeca at 7%, Sachem Cove at 7%, and a host of others, including Segra Capital, L2, and a host of others under that sort of substantial threshold. In fact, our register shows about 45% institutionalised. And with that, I'd like to conclude the presentation, and there's another view of the Honeymoon Uranium Mine. Thank you.
Thanks very much, Duncan. We've been besieged with questions. Let's try and put them in some sort of logical order. One viewer has asked, why was the project mothballed in the first place?
It was really due to three reasons. One, the Fukushima incident occurred and really demand for uranium dropped off with Japanese utilities winding down. The second aspect was that Uranium One was struggling to get the right tenor of uranium from their well fields. So that on average, they were achieving about a 53 milligram per litre. What we did was run a field leach trial in 6 months in 2017, and we were able to achieve an average of 80 to 100 milligram per litre over that whole period, which was far in excess of what our head grade needs to be. And we did that by drawing upon the expertise of Bryn Jones and what the General Atomic guys used 300 kilometres to our west, adding more ferric and lowering the pH level. The third aspect was that they simply were running sort of an inefficient plant and not getting the right production capacity. So that's where ion exchange really comes into its own, that we're able to now take it from being a sort of 1 million pound producer up to a nameplate capacity of up to 2.45 million pounds per annum.
Right. So you believe that the technical problems the previous owners had, you have overcome?
Oh, no doubt. I mean, we haven't just done this ourselves. We've also partnered very strongly with ANSTO, Australian Nuclear Science Technology Organisation. We've had industry international experts such as Dudley, many ISR international people from America sort of help us with that process. And we've been fully validated by many, many people within the industry. So much so that more recently we've had several utilities taking a deep dive on us technically. So that's when, before they start sort of entering into contracts, we're not there on price or quantity yet, but what they are doing is allocating resources to these technical independent bodies of engineers to then do a technical deep dive where they really go through all the technical aspects of the feasibility study. It's a lot of questioning, a lot of responding, and we've passed those with flying colours. So what that sort of demonstrates to us is that we've got the credibility in the industry by the utilities. So when the prices do rise, we know that we'll be there to meet the market demand. We know that when they also balance up the number of projects around the world, Australia's in the front of the queue, being such a low geopolitically, or a very stable geopolitically country in which to operate.
There's a lot of interest in the price. You mentioned that it started to tick up. How do you see it going from here? What will be the next catalyst to drive it?
The next catalyst, it's fascinating, and it's a difficult one to grasp initially, but the way fuel buyers operate is that they really are following a herd mentality. So they're working for huge operations, big organisations such as our main power providers within Australia. And it will take a very brave fuel buyer, to be the first to accept a higher contract price. But the pressure's on them. Brave in the sense that they've then got to convince their senior executive that now's the time to enter into those long-term contracts. So I think what's really going to drive the price now is just that initial utility to say, okay, our inventory levels are low now. They're less than 2 years, which is the standard requirement. Now's the time that we have to start entering. And when that starts and it's widely acknowledged, I think that herd mentality will then follow, as it did in the last cycle.
So what's the next steps for Boss in terms of counting down to production?
Boss, we'll continually release sort of some of our exploration updates, but really the key milestone now is this enhanced feasibility study due out in the second quarter of this year. As mentioned, hopefully late April, early May. But really that will then finish our sort of technical work that we then need to do. In the meantime, Sashi and I are staying very closely engaged with utilities. We're making Boss Energy aware, or sort of the market aware of who we are. We're engaging once a week or a couple times a week at least with fuel buyers. And it's really, just keeping warm and ready and getting ready to go.
So will that enhanced feasibility study, once that's completed, will that pave the way for you to sign off on funding and offtake?
It will put us in a position to do that. Really, to secure the funding is dependent upon the offtake. So we need to sort of land those initial offtakes. But as mentioned, the fact that by then, hopefully, we would have had, say, a handful of financiers ready to finance the project. By landing the offtake, it then would start that whole process of getting debt finance and getting ready to go.
Right. Duncan, thank you very much.
Thank you.